Good afternoon. My name is Suzetta Furlong. I'm the Chief of Operations with the Division of State Group Insurance. Thank you for coming to our presentation today. I'm going to talk to you about what it means for you to continue benefits as a retiree through the State Group Insurance program. So you may be asking yourself, well, who are you? I've never heard of you. The Division of State Group Insurance is a division within the Department of Management Services, and we are responsible for your pre-tax insurance benefits. Your health, life, dental, vision, accident, cancer, and all those other benefits that you may have that you pay for on a pre-tax basis as an employee. We're the ones who manage those different contracts and procure those for you. We are also, in essence, a health insurance company because we are self-insured for the majority of our health insurance book of business. What that means is that we actually pay the claims for prescription drugs and medical claims for more than 360,000 people. Our health insurance program is a $2.2 billion program. Lots of money goes in and out, and we're going to be talking about some of that money later on in the presentation when we talk about the premiums that you will be looking at. So that's a little bit about who we are as a division. I want to tell you one thing to help you be familiar with some of the terms I'm going to use. Whenever I say retiree, I mean walking out the door. I know that in your presentation this morning with the Division of Retirement, they would talk about whether you're a retiree or whether you're leaving drop, things like that. For us, we don't care whether you're in drop or what your situation is. You're a retiree when you're leaving employment, okay? So I want to be sure that everybody's with me whenever I say retiree. It means you're what? Walking out the door. That's right. Very good. So, one of the things that I want you to look at, and we're on slide 87 of your package, if you have printed that package out and brought it with you today, is that whenever you're a retiree walking out the door, your HR office is going to enter a personnel action in People First, and that's going to retire you. When that happens, People First is going to mail you a package, and it's going to have all kinds of information in it, and a lot of it is information I'm going to cover today. If it's information that you're just dying to read and you just cannot wait, it is available at the My Benefits website. That's the second bullet there, mybenefits.myflorida.com, and you can get a sample package and read it this very day if you are that excited about it. In addition to the new retiree package that you will get from People First, you are also going to get a COBRA package, and we will talk about what that means just a little bit later. Once you get all your forms and your packages, then you will submit everything to People First, and you will be good to go in terms of your coverage as a retiree. And again, we're going to talk about these things step by step. You may not know that you can have your health and life insurance for the rest of your life through our program if you do a few things. One, you have to be enrolled in health or life at the time you retire. So if you're enrolled in health, you can continue health. If you're enrolled in life, you can continue life. Most of you are probably already enrolled in life insurance because we automatically enroll everyone for the $25,000 basic life insurance. So unless you have gone in and canceled that plan for some reason, and some people do, you are already enrolled in the basic life benefit. If you meet the vesting requirements, which you obviously will because your HR office is retiring you whenever you're walking out the door, and if you elect to continue your coverage, and if you pay those monthly premiums. And we're going to talk about monthly premiums in just a few minutes. Take a look, if you would, very quickly at the handout that I gave you that looks like this. It actually looks like it's slide 92, perhaps. Slide 92 in your presentation. I'm going to cover a few slides that will help you understand what this chart means, what all the different terms on the chart mean. Some things may not be familiar to you, okay? The numbers are there. We're going to get to the numbers, but first you need to understand all the labels. So let's talk about, first of all, what a PPO plan is. Our PPO plan is administered by Florida Blue. In a PPO plan model, you pay a deductible. That means just like for your homeowner's insurance, you have to pay a certain amount before the insurance company kicks in. You also pay co-insurance, so you pay a portion of a claim and then the insurance company pays a portion of a claim. If it's a network claim, it's typically the insurance company pays 80%. you pay 20%. You also pay co-payments in the PPO plan model. If you go to the doctor's office, you have a $15 co-payment as an example, and then that's all you have to pay. So you do have a little bit more money out of pocket in the PPO plan. The benefit of that to you is that you have a nationwide network. You can go to any provider that's in the Blue Cross Blue Shield network nationwide. They actually even have a worldwide network that you can access. So you have much broader access to doctors and hospitals. There is also an out-of-network benefit that you can have. So if you go to an out-of-network doctor, because that's the specialist that you really want to see, you've heard that is the man or the woman who's the best in the business, you can go to that person and there is an out-of-network benefit. It's not as good as the in-network benefit, but there is a benefit. And then you can also see any specialist without a referral that you would like to see in the PPO plan. So let's juxtapose that to the HMO plan, and I'm going to be specifically talking about Capital Health Plan today because they are the HMO in this area, in the Tallahassee area. In the HMO model, you only have co-payments. So that's nice because you have a known fixed amount that you would pay as opposed to a deductible and co-insurance. In exchange for that fixed amount and smaller out-of-pocket cost, you have a more limited network. You can only go see a physician, a specialist, or go to a hospital within the network. If you go out of the network, you essentially have no insurance unless it's a certain type of an emergency. So that's the difference, okay? More money out of pocket in the PPO plan gives you broader access to physicians. Less money in an HMO plan gives you more limited network. Also with Capital Health Plan, there are some specialists that you can see without a referral, but many specialists do require a referral from your primary care doctor. That's the difference between those two types, talking about a PPO and an HMO. Now we can break those down a little bit farther because we have a couple of other variations on a theme of those two plans. We have a standard plan, which is probably what most of you are enrolled in today, and we have a high deductible health plan. The benefits in the standard plan and the high deductible plan are the same in terms of what's actually covered. Going to the doctor's office, medications, certain services, those things are all the same. The difference is how much money you have to pay. In a high deductible health plan, it's as you might expect, the deductible is high. You have to pay, if you're covering just yourself in single coverage, you have to pay the first $1,300 out of pocket before the insurance company kicks in, except for a few preventive services like your annual wellness exam. If you're in family coverage, you have to pay the first $2,600 out of pocket before the insurance company kicks in. Now, as an active employee, it can be a great plan for you because the monthly premium is less expensive, and you also get a contribution from the state for a health savings account. But retirees do not get a deposit from the state for the health savings account. So the benefit for you as a retiree would be, yes, a lower monthly premium, but you're going to have that high deductible that you have to meet before the insurance kicks in. So you'll have to weigh whether that would be worth it to you. Early retirees. So I'm going on to slide 91, I think it is. Let's talk a little bit. This is also going to be on that chart we're going to talk about in just a minute. Early retirees, and we consider people who are early retirees those who are not eligible for Medicare Part A or Medicare Part B. And we are going to talk about Medicare in a few minutes, okay? So bear with me on that. If you are an early retiree and you only want to cover yourself, that's single coverage. If you are an early retiree and you want to cover yourself and one other person or 5 other people, as long as they're all eligible dependents, you may do that. That's family coverage. When we look at that chart in just a second, you're going to see the chart that says early retiree, single, and family, and then you'll be able to find out what that monthly cost is. There are 3 different coverage tiers for people who are eligible for Medicare. Medicare 1 is a plan just for you, single coverage. Medicare 3, and I know I'm going out of order, but it's easier this way, I promise. Medicare 3 covers you and one other person, and you are both eligible for Medicare. Medicare 3 covers you plus one other person, and you're both eligible for Medicare. Medicare 2 coverage tier is any other combination that you have. So it covers you and your spouse, and only one of you is eligible for Medicare. It covers you, your spouse, and a child, and one of you is eligible for Medicare. So any other combination is where you fall in the Medicare 2 tier. I think I've described now all the different labels, so let's look at that very scary premium chart that I gave you before. The first thing I need to do is let you know, and it doesn't say it, I don't think, on my screen. These numbers are not going to be what I've given you, and I apologize, okay? But at the very top of this paper, it says monthly retiree premiums. These are per month. You may not be aware that during your tenure as a state employee, your employer has paid on average 90% of your health insurance premium. We have an extremely rich benefit plan. We cover lots and lots of things that are not covered out in the private sector, and your employer has paid a lot of money every year for you to have that coverage. So that's a great benefit while you're an active employee. Florida statute says, our statute, which is 110123, says that once you become a retiree, there can be no state funds contributed toward your insurance. So at that point, you have to start paying what you paid as an employee, plus what your employer has paid for you all these years. That's why these numbers look a little frightening. So let's look at the category called early retirees. When you retire, if you're not going to be eligible for Medicare, and there are two ways that that happens. One, you're going to be 65, or one, you're going to be Medicare eligible due to disability, and that has to be approved through the Social Security Administration. So when you retire, if you're not going to be Medicare eligible, you fall in this early retiree category. If you only want to cover yourself, look at the cost for single coverage, and on the chart that I've given you, that's $692.84 per month. That's for the standard plan. You remember I talked to you about the high deductible plan? That's the one that you have to pay the $1,300 or the $2,600 out of pocket first. Okay, that one costs a little bit less at $616.18 per month for single coverage. But remember, you have to pay the deductible first. So you have to weigh that as part of the balance. If you're wanting to cover another eligible person, that would be your legal spouse, a child up through the age of 26. You want to cover a legal dependent, then you would be in family coverage if you're not eligible for Medicare, and you can see the cost of that per month. I'm so glad none of you brought tomatoes back with you from lunch. All right, let's look at the Medicare chart. We talked about the fact that if you are if you're going to be Medicare eligible, age 65 when you retire, and you're only going to cover yourself, you're going to be in a Medicare 1 tier. If you're going to cover yourself and one other person, and you're both eligible for Medicare, you will be in Medicare 3. And if you're going to cover yourself and one other person, or any other combination, and one person is eligible for Medicare, then you would be in Medicare 2. You can see how this is set up so that you have the PPO plan, standard premiums and high deductible premiums, and then the capital health plan premiums that go across there for each different tier. I realize it's sticker shock. All right, going to move on. That is the cost of insurance through us. We're going to talk about Medicare right here, looky here. So Part A, we're on the next slide now, which I think is slide number 93. Part A is free. It's hospitalization coverage. And as soon as you become age 65, you should enroll in that coverage because it's free. Why wouldn't you? And that is a great benefit that the federal government offers to you. Part B is medical coverage. Part B is medical coverage. So this is doctor's office visits, x-rays, labs, things like that. It has a monthly premium, and right now the premium is about $115 per month. So the premiums that you would pay here on this chart for your Medicare coverage are in addition to the premium you would pay for Medicare Part B. We're going to get to that. I've anticipated all of your questions, I promise. Can you hold that thought for just a minute? Thank you, in case I cover it. Okay, so Part A, hospitalization, free. Be sure you enroll. Part B, medical services, some prescription drugs. That's only if you have really, really bad stuff, and most of you, that's not going to happen to any of you. There is a monthly premium. Part D is a prescription drug plan. If you are going to stay in our health insurance program, you do not need to enroll in a Medicare Part D. In fact, don't enroll in Medicare Part D, because if you do, it's going to mess you up. All right? Medicare Part D is only if you're going to leave our program and you need prescription drug coverage through another insurer. If you're going to stay in our program, our prescription drug plan is considered creditable coverage. The federal government says ours is good as or better than their plan. And the nice thing about our prescription drug coverage is nothing changes whenever you become a retiree. The co-payments stay the same, the covered benefits are the same, so everything stays the same if you stay in our plan. So let's talk now about, somebody mentioned a second ago, so we're a supplement plan. Sort of, kind of, not really. There are two different groups of insurance here. One is secondary insurance, which is what we are. A secondary insurance plan pays secondary to Medicare. What that means is that Medicare pays first and typically pays about 80%, and we pay the other 20%. So you, in essence, have no out-of-pocket cost. If you have a service that Medicare does not cover, we will pay, if it's a covered benefit in our plan, we will then pay for it as we normally would. That's what a secondary plan will do for you. For your prescription drugs, we are your primary payer. Remember I said we're creditable coverage, we're as good as Medicare Part D, so we are your primary payer for prescription drugs. A Medicare supplement plan works just a little differently. You'll often hear them out in the world called Medigap plans. They tend to, not always, but they tend to be a line item by line item. So if Medicare covers it at 80%, then they may cover the other 20%. If Medicare doesn't cover it, they don't cover it. But there are some exceptions to that, and you would want to shop around. But that is the difference. Medicare secondary, which is what we are, we will pay if Medicare doesn't pay, as long as it's a covered benefit under our plan. Now let's talk about a Medicare Part C plan. That's a Medicare Advantage plan. Capital Health Plan offers a Medicare Advantage plan through our employer group plan. So does Florida Healthcare Plans if you're planning to move to the East Coast. They're in Volusia and Flagler County today. These are plans that are approved by Medicare, and they will have similar benefits to ours, not identical, but very similar, and they are rich plans just as we have today. Whenever you enroll in a Medicare Advantage plan through Capital Health Plan, you have the same network that you have as if you were still an active employee. Your benefits may look a little bit different. You still pay the Medicare Part B monthly premium, and you also would pay the Medicare premium on this piece of paper that I shared with you. Okay. Now, the thing about the Medicare Advantage plan is that it does have its own prescription drug coverage. They have some other benefits that Medicare requires that we do not. So whereas they may not cover a few things, there may be some other things that they do cover. One of the things that's really popular, I think, is their Silver Slippers program, which is all about going to the gym and being fit and active and healthy. So there are those types of things. Now, if you're going to be in a Capital Health Plan and you're going to be Medicare eligible when you retire, or after you retire you become Medicare eligible, you must complete a separate application with CHP. You have to submit that to them, and then they will let us know that everything is okay, and we will start taking your money, and everything will be just fine. You don't have to do anything extra if you're going to go into the PPO plan, Florida Blue. But if you're going into Capital Health Plan, you must fill out their Retiree Advantage Plan application. And if you call them, they will gladly tell you how to get it and how to fill it out and where to send it. Yes, sir. The question is if I move out of the service area, I think, is it going to be a problem? If you, and this is one thing we're going to talk about, if you move out of the service area, if you move out of CHP service area, that's a qualifying event for you to change plans. So we'll get to that in just a minute. All right? Eligibility, if you'll just trust me, okay? Eligibility for Medicare at age 65. Once you turn 65, if you're retired, when you're retired and you turn age 65, we're going to automatically enroll you in a Medicare plan. That's good for you because that means you're going to start to pay that lower premium, right? We're going to automatically put you in that lower plan. Here's the important thing. You have to remember to enroll in Medicare Part B. If you decide not to enroll in Medicare Part B because you don't want to pay that $115 a month, you don't want that to come out of your Social Security check, you don't have to, but we are still going to be your secondary plan, and we're going to pay like a secondary plan. That means you won't have anybody to pay that first 80% except you. That could be quite costly. So it is in your best financial interest to enroll in Medicare B as soon as you are eligible. Now, the Social Security Administration will not let you forget that you're about to turn 65. They are going to send you all kinds of paperwork and letters saying, hey, it's time for you to enroll in Medicare Part B, and you're going to jump right on that and get with it so that you can do that. As soon as you get your Medicare card, if you will send that to People First, and they can make sure everything is looking good in our system, and you will be ready to rock right along. If you become eligible for Medicare as a result of a disability, then you must notify People First because we would not know unless you tell us. And if you don't tell us and we later find out that we've been paying primary and we should have been paying secondary, that could be problematic, right? So it's important that you let People First know if you are determined to be disabled by the Social Security Administration and you are now eligible for Medicare. Very important that you share that information with People First so that we can be sure that you're in the right coverage tier and that we are paying your benefits appropriately. Let's talk a little bit about options upon retirement for your health insurance. So how many of you are in the pension plan? Just about everybody. A few investment plan members today? No? Pension? So we'll stick with pension plan. Pension plan members, if you're enrolled in health insurance whenever you retire, and that means out the door, we're going to automatically enroll you in retiree health insurance. Now, if you decide you don't want it, that's okay. You can call People First and cancel it, or you can not send in your first month's premium and you'll cancel because there's no money there, right? But we are going to automatically enroll you just to give you that little added protection because things get busy. Maybe you've already planned your cruise and you're not thinking about enrolling in health insurance, so we're going to take care of you that way. You do need to send your payment by the end of that first coverage month. And here's the one nice thing that you may not know. You know how we pay for our insurance premiums 1 month in advance? So we are paying right now in October for November coverage. That means that when you retire, if you work 1 day in the month, you're going to get that next month coverage as an employee. So if you retire in November, you will have coverage in December as an employee, and so you don't have to start paying that big premium until December for January coverage. So you do get a little bit of a reprieve in there to try to scrape that money together. If you want to have your money taken as a pension deduction out of your pension check, you may do that. Call People First and they will set that up with you with the Division of Retirement. You can also write a check each month if you would like to send the bill, and I believe you can pay up to 6 months in advance if you're that adventuresome. And then you can also set up to have your bank pay on your behalf each month. They can do an electronic payment for you. Now, someone asked me a minute ago, what happens, if I move out of Capital Health Plan service area? Is that a problem? You have several options whenever you retire. One thing you can do is you can reduce coverage from family to single. Let's say that you are today covering your spouse under your health insurance plan, and you've decided, nah, I don't know that we can really afford this, honey. You better go get through your employer, and I'm going to continue through state group insurance. You can do that. You can reduce to single coverage at any time you want, at the time you retire or any time thereafter. You can cancel coverage anytime you want. However, if you cancel coverage, you cannot get back in. And then you're sitting there thinking, well, that's not very nice. Well, there's a reason for that. We don't want people, remember, we're the big bad insurance company. We don't want people to cancel health insurance coverage and then 3 years later, when they need a $25,000 hip replacement, decide they want to come back on the plan and have insurance. That's not the way insurance works. So remember, Insurance 101 says everybody contributes to help take care of those catastrophic things that occur, and the pool has to build up. That's what needs to happen here. So if you're going to cancel our program, we don't let you come back in unless you go back to work. Then you can have it as an active employee. But if you leave as an active employee, you don't get to retire again. You are not eligible again as a retiree. So if you ever decide to leave, there's no opportunity to come back as a retiree. If you move out of the service area, if you're in an HMO, such as Capital Health Plan, and you move out of the service area, that's a qualifying event for you to either enroll in the PPO plan, Florida Blue, or enroll in an HMO that is in that service area. We have different HMOs around the state. They change from time to time based as the result of procurements. But we do today have AvMed, Aetna, United, and Florida Healthcare plans around the state. So you would have the opportunity to change at the time you move. No, sir. You may live anywhere in the United States. If you live in the United States, you need to enroll in the PPO plan. Your HMO eligibility is based on, as a retiree, is based on the county in which you live. The county in which you live. You are eligible for the PPO no matter where you live in the world. Yes. Okay, real quick. Yes. Now here's the good news. If you are the lucky one in your relationship and you are getting to retire first, and your spouse also works for a state agency or a state university, you can become a dependent under your spouse's plan and still continue to pay that lower cost active employee premium. And then whenever your spouse gets ready to retire, then you can roll back out and enroll in retiree coverage. So that's a nice option for you. Maybe some of you are thinking, I better go home and tell honey they need to get a job with the state, right? But that's a nice thing for you to do if you and your spouse are both employed by the state. Whoever retires first needs to become a dependent under the active employee coverage, and then you can have your retiree coverage when that person leaves. Sir? Medicare, you become Medicare eligible at age 65. If you retire when you're 70, you're eligible for Medicare. If you retire when you're 65, you're eligible for Medicare. Now the thing, here's an important point. If you are 65 now and you're still employed, or you turn 65 while you're employed, you don't need to do anything except call the Social Security Administration and say you would like to defer Part B. Defer Part B. You don't want to enroll in Part B and pay a premium now, because Medicare is going to say, hey, you're still employed. that company has to pay as a primary insurer for you anyway. You don't want to pay for that. So the important thing to remember, as long as you're actively employed, you defer Part B once you become Medicare eligible. It's when you retire, if you are eligible for Medicare at the time you retire, or you subsequently become eligible for Medicare, that's when you need to act quickly and enroll in Medicare Part B. I'm moving on to slide 100. Yes. Going to talk about those in just a minute. Okay. If you are not today, in first part of yours is a good point. If you are not today enrolled in health insurance, you must be enrolled at the time you retire to be eligible to continue health insurance. So it's important that we have open enrollment coming up, and if you're thinking you would like to have health insurance through the state as a retiree, you should go ahead and enroll this open enrollment and be sure that you have that coverage. Now this is the next slide I want to talk to you about is the surviving spouse benefit. You may not be aware that this is available to your spouse today with you as an active employee, and it's also a benefit available whenever you retire. If your spouse is covered under your health plan and you die before your spouse may continue health insurance for the rest of his or her life, as long as they pay the premium and they cannot remarry. It's like, I don't know if it's because we like to promote living in sin or what that is, but just kidding. Actually, it's because the idea is that if they were to remarry, they would have access to health insurance coverage through their spouse. So that is a benefit that's available to you today. There is a process for that. If your spouse, you need to tell your spouse how this works. If you predecease your spouse, and your spouse should call People First. People First will ask for a copy of the death certificate and ask for a completed application, and then send in the monthly premiums each month. I know that this morning Division of Retirement already talked to you about the health insurance subsidy certification. That's that $5 multiplied by your years of service up to $150 that you get each month. That you get as a line item in your pension. It does not reduce, I don't know how to say this, it does not reduce that premium amount on this page. Okay, it's not going to reduce so you're not going to see $150 subtracted from this number. You're going to see this number as a deduction, and then you're going to see the $150 as an additive in your pension. Now, in order to be eligible for the health insurance subsidy, I'm sure Retirement already talked to you about this. If you're staying in our program, Division of Retirement is going to mail you the subsidy form. All you have to do is send it to People First. People First will fill it out for you and send it to Retirement on your behalf. It's very nice. If you decide you're going to leave our program, then you will have to work with whatever insurance company that you are going to be joining to get that form completed, and you will have to send it to the Division of Retirement. So send it to People First if you're staying in our program. That does it for health insurance. Let's talk about life. We are just this week mailing open enrollment packages, and you may see an announcement or have already seen that Minnesota Life is changing its name to Securian. So this will be the last presentation where I use Minnesota Life. Minnesota Life is as I said, covers most of you today at the $25,000 basic life benefit. If you have that benefit today as an active employee, we're going to automatically enroll you in life insurance as a retiree. There are two different benefit levels as a retiree. One is a $10,000 benefit, and you can see the premium there is $19.33 a month. And the other is a $2,500 benefit that's $4.83 per month. We're going to roll you into the $2,500 benefit. If you want the higher benefit of $10,000, then you must call People First, or else send in your application to People First, and they will put you in the $10,000 benefit. If you don't want to continue life insurance as a retiree, of course you don't have to, but if you cancel, what will happen? You can't come back. That's correct. Minnesota Life offers additional benefits with their term life product. There is an accelerated death benefit. You have access to that today as an active employee. You also will have access to it as a retiree. If you are diagnosed with a disease and your life expectancy is less than 1 year, if you provide the proper medical documents to Minnesota Life, they will pay you any amount up to the maximum benefit that you're eligible for in advance of your death. So if you have all kinds of whatever you want to do with that money before you die. There's a repatriation benefit. This is a new benefit that we negotiated last year. If you die more than 75 miles, I believe it is, from your home, Minnesota Life will pay to have your remains brought back so that you can be buried in the area. And there is a dollar limit. I can't remember what that dollar amount is, but there is a dollar limit. So if you're in Europe, it may not pay for the entire cost to fly you home. Yes. 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 These benefits are part of your active $25,000 benefit that you have today. You also have conversion privileges, and I don't like to get too much into the details about the difference between conversion and porting because I always get them backwards, but you can convert some of your life insurance, and if you're enrolled in optional life insurance, that's the one where you do 1 times your salary, 2 times your salary. You can either convert or port, whichever way that goes, one of those. To do that, you need to call Minnesota Life. I will tell you that once you decide to do that, you have left the group plan, and you are then being insured as an individual, and the premiums do increase a great deal at that point. Mostly people who choose to do that who are people who cannot get life insurance anywhere else because they have a pre-existing condition. One of the things you need to remember to do on an annual basis, if you have any changes in your family situation, is to update your beneficiaries. That's especially important whenever you decide to retire because things have changed for you, right? Your whole monetary situation changes. So be sure that you go onto the Minnesota Life website. You can do it through their site. They have instructions on how to log in. Or you can complete a form and send it to Minnesota Life and they will update it for you. But be sure that your beneficiary designations are established the way you would like for them to be. If, while you are still working, you become disabled, you may qualify for a waiver of life insurance premium through Minnesota Life. It's only if you are still working and this occurs. So if you become disabled before you retire, you should call Minnesota Life and talk to them and ask them about your ability to get a waiver of life insurance premium. That means you would not have to pay the premium each month, and you could keep the greater benefit as opposed to the lower retiree benefit. You must call them while you're still employed. Yes, before you're 60. Yes, as the slide says. Thank you. Let's talk about dental and vision. Dental and vision are available to you when you retire through COBRA. If you are enrolled in dental and vision at the time you retire, you're going to get a COBRA package in the mail, and it's going to tell you what you need to do to continue that coverage if you want it. The dental insurance premium today that you pay and the vision, you pay 100% of that premium. The employer doesn't contribute anything to that. Whenever you have COBRA coverage, you pay the full premium plus a 2% administrative fee, so it does increase just a little bit. You have the same options with those two plans that you do with health insurance. You can reduce coverage to single if you don't want to cover a spouse or children. There are options to get that number down just a little bit. You are not automatically enrolled in dental and vision coverage as a retiree. If you want these coverages, you must make an active election through People First. You may either call People First or you may fill out the COBRA package and mail it to them to be enrolled. Again, you must pay your premiums timely. If your premiums don't get there in time, then you have a couple of problems. One, premiums always need to be paid by the 10th day of the month for the next month's coverage. As an example, you would need to pay November's premiums by October the 10th. That ensures that your payment can be processed, it goes through the bank, the payment's good, it's posted to your account, and that you go over on what we call a file that lets the insurance company know that you have coverage. If your payment is late, then all of those steps may not occur and you may not go on the file, and then it looks like you don't have coverage. If your payment arrives after the coverage month, if you're supposed to be paying for November and your check doesn't show up till December 3rd, your coverage is canceled and you do not have the opportunity to re-enroll. That's for all of the plans, not just dental and vision. That's the way it works for all of the plans that you continue through our program. If you decide that you want to continue your dental and vision plans after retirement using the COBRA model, you will have it for 18 months if you choose to keep it that long. And some of the companies do offer conversion privileges, so you could call them and ask them if you would tell them you would like to convert, and they will let you convert over to an individual policy if you would like to continue that coverage. Let's talk a little bit more again about some changes that you can make after retirement. As we've already mentioned, you can reduce your coverage at any time. You can cancel your coverage at any time, but you can't get back in. Your coverage cancels if your money is not received timely, as I just described to you. So that it's whether you voluntarily cancel or you cancel because your money doesn't arrive on time for whatever reason. Once you're out, you're out. So very important that you think that through. Any plans that you continue as a retiree, health, life, dental, vision, you can make changes to those plans during open enrollment. If you are enrolled in a specific dental plan as a retiree through COBRA, when the next open enrollment rolls around, if you want to change dental plans, you can do that as long as you're still within your COBRA coverage window of 18 months. You can change health plans during open enrollment. You can go up to family coverage or down to single. You can make any changes that, just like you can do today as an active employee during open enrollment, as long as you are enrolled in the plan. During the plan year, you need a qualifying event. Today is the same situation. You either have a work event or a life event. For example, you get married, you have a baby, you get a divorce. Those are events that allow you to make a change to your plan today. Those are the same type of events that are required as a retiree. Let me summarize one thing for you. As a retiree, you can go down from family to single coverage at any time. To go back up in coverage, you have to have a qualifying event or wait until open enrollment. Let me give you a real-life example. This really happened. We had a woman who got mad at her husband, and she called People First and said, "Take him off my insurance." She was the retiree, and so People First took him off her insurance. And a few days later, she called back and said, "I've changed my mind. I'm not mad at him anymore. Put him back on." Can't do it. She didn't have a qualifying event. She had to wait until open enrollment. So I would recommend that if you are that angry with your spouse, make him or her sleep on the couch. Okay? Don't take them off your coverage. Okay, we've talked about the next slide about paying monthly premiums, that they're due by the 10th of the month before the next month's coverage. We've talked about the fact that you may look like you don't have coverage. It can be suspended. We've also discussed the fact that you can have People First work with Division of Retirement to have your premiums deducted from your pension. That's your health insurance premium and your life insurance premium. If you continue dental and vision, you do have to mail a check for those. Those cannot come out of your pension, only your health and your life. Sometimes people ask me if those are pre-tax deductions like they are today for you as an active employee. They are not. They are post-tax deductions. They're always post-tax after you terminate employment. And as I said before, you may send a check, a cashier's check, a money order to pay your premium each month if you would like, or you can work with your bank or credit union and they can set up direct payment to People First on your behalf. That is a very convenient option for you. The one caution I would give is that whenever premiums go up, and regrettably they do, you need to remember to tell your bank to increase that premium so that you don't get into an underpaid status. So speaking of premium increases, the premiums that I gave you on that piece of paper are effective this December for January coverage. Every year during legislative session, the Florida legislature looks at our program and has to balance the amount of money coming in to pay for claims and the money going out. They make the decision to whether or not the premiums need to increase. Some years there are no increases, some years there are. I didn't bring my magic 8 ball, so I can't really tell you what's going to happen next session, but I can tell you what we have today. Sir? The company. Correct. The question is, if I continue dental and vision, I go through my 18-month COBRA window, and I want to convert to an individual policy, whom do I call? You do call the insurance company directly. People First won't have anything to do with it at that point because your coverage will be ended through the state. Other supplemental plans. Some of you may be enrolled in accident, cancer, disability, hospitalization, or hospital intensive care through our program today. Some of you may have some of those products on a post-tax basis. Some agencies do offer those to their employees on a post-tax basis. You need to be sure you know what you have, okay, to keep up with that. You'll know if it's in our program because when you get your open enrollment package each year, it will show you what you're enrolled in, and those are your pre-tax benefits. Those are the ones that I'm talking about today. If you're enrolled in something through another company, that's a different conversation you need to have with that company as far as what you do when you retire. It's really important that you remember there are two different things going on there. You should check your policy if you're enrolled in any of these other supplemental plans. Some of them have age limits that either the benefits reduce or the benefits stop paying if you get to a certain age. That's when you're an active employee. So you want to be sure that you take a look at that. Some of them no longer provide any coverage once you become eligible for Medicare. So also check your policy. Some of these companies do offer conversion privileges. You cannot continue these through our program, through People First. You cannot continue these plans through COBRA. If you want to continue any of these plans as a retiree, you must call the company directly and ask about conversion rights. And then you would send any monthly premium to that company, not to People First. Flexible spending accounts. All kinds of things going on in the state group insurance program. We have a healthcare flexible spending account. For many years we called it a medical reimbursement account. That may ring a bell for some of you. Only expenses that you incur before your last payroll are eligible for you to be reimbursed. So whenever you're thinking about retirement, and if you still have a bucket of money sitting there, you can use that bucket of money up until the date of your last payroll. If you still have a lot of money sitting there, you don't want to lose it. Remember, this is a use it or lose it account. You can COBRA your healthcare flexible spending account. And there's a form called Options to Continue Your Flexible Spending Account form, and all you have to do is fill that out. You may want to get with your HR office for a little bit of help or call People First. Actually, today you should be calling Chard Snyder, and then they will help you, and you'll mail that in, and you can then use the rest of that account just like you would if you were an active employee, meaning you would have until March 15th to incur your expenses, April 15th to file your claims. That's a nice option that you can COBRA that flexible spending account. You can also, if you would like to do it on a pre-tax basis, you can use any money from your leave balance. Any money from your leave balance. You don't have to write a check. You can use your leave balance money to pay the rest of that money and still get the pre-tax benefit of that. For those of you who are enrolled in a flexible spending account, today you have that red Benny card. That Benny card is going to deactivate whenever the termination is completed. So whenever you retire, that card will no longer work. But that's okay, because if you continue your flexible spending account through COBRA, all you have to do is do like the good old days where you send in a claim form and the appropriate documentation, and then you will be reimbursed. Sir? You're not going to be able to, the good question, can I overspend? You cannot, because the Benny card has a limit. It's a prepaid card. It won't allow you to go over, and if you submit a claim for more than money you have in your account, then Chard Snyder is going to deny your claim. Right. So if you spend $1,500 in January, the most you can be reimbursed is $1,000. That is correct. This is, as I said a minute ago, this is a use it or lose it account. That goes both ways. It works for you and for the state. You are correct. That money is available to you on January the 1st for a healthcare spending account. And if on January 2nd you spend all $2,500 and you retire on January the 3rd, lucky you. Nothing that we can do about it. We will not ask you. We will not ask you for that money. On the flip side, if you get to March 15th and you haven't spent all of your money, then we get to keep it. That's federal government, not state government laws that drive that. Yes, ma'am? That is correct. Whatever the dollar amount is available to you on the first day of January, if you spend that, even as an active employee, at any point before you've paid for the account in full, we give you that as an interest-free loan on January the 1st, and you are not obligated to pay it back if you terminate employment. We've actually had people who've tried to pay us back, and we have to tell them, no, we cannot take it. Federal government won't allow it. Let's talk about your dependent care account. Now here's something that many of you may not have as you're thinking about retirement, because most people think of a dependent care account as for a person who has children to take care of, daycare expenses and things like that. But if you take care of an elder parent or a spouse who is a qualified dependent under the IRS, you can claim that person on your taxes, and you have elder care expenses, as an example. Not medical. This account is not for medical. But if you have dependent care expenses, so you send your elderly father to adult daycare every day, and you pay for that, and you claim your father on your tax return, you could have a dependent care account as an active employee. As a retiree, it's not an available option for you, but as an active employee, you could have one. If you are enrolled in one of these today as an active employee, then you may submit claims incurred as of the last payroll deduction, and then it just ends. This particular account does not front you the money on January 1st. The money is only available as it's deducted from your paycheck each month, so there's no way to get out of whack on this one. If you're enrolled today in a high deductible health plan and you have a health savings account, your health savings account contributions from the state will end at the time you retire. You will no longer be able to contribute money on a pre-tax basis to a health savings account as a retiree. But you do get to take your health savings account money with you, and you can use that money to pay for eligible expenses. Eligible expenses include Medicare premiums or other health insurance premiums, as well as doctor's office visits, prescription drugs, glasses, and things like that. So here is our contact information right here at the very end. You can always go to the My Benefits website to learn more. People First is your primary source of information, so call them for your questions about your benefits and what to do whenever you retire. If you have questions about what's covered or about network, like is a doctor or a hospital in my network, you should call your health insurance company for that. If you're thinking about having dental work done, and your dentist is telling you that it's going to cost a good bit of money, like over $500, call your dental plan, and they will give you a pre-authorization and give you a cost estimate that you can use so that you have a better idea before you have that work done. So what I'm trying to illustrate to you is for plan benefits, call the insurance company. For enrollment and eligibility, call People First. Here are all the addresses for you to mail your money, because of course we always want your money. And I think that will do it for us this afternoon. Thank you very much for your attendance and your time.